Hey everybody, Tim Melvin here. Welcome to this week's Hidden Profits Report. Guys, get a cup of coffee, settle in. We're going to be here a while, but this is going to be one of the more interesting and I think profitable discussions that we've had in a while. We're on today with Ray Micaletti, who was introduced to me by our good friend Wes Gray, who, if Wes is involved, I always want to know more. But the more I looked into the work that Ray is doing, the more impressed and interested I got. He's doing some things with relative sentiment, which everybody talks about, right? But Ray's the first one that I've met that can actually explain it and what it is and how he arrives at it, and more importantly, how he uses it. And he's got an ETF that does this. The symbol's MOOD. But even if you never even bother to check the quote or put money into that ETF or anything else, what we talk about today, I think, can make you a much better investor. Now, Ray has a different background. Okay, he doesn't come from finance. Ray has a BS in civil engineering from the University of Notre Dame. Full disclosure, I'm an Irish Catholic kid who grew up in the 60s. So, Notre Dame, if you went to Notre Dame, you're automatically a good guy. That's just, according to my uncles, that's how this works. And then he has follow that up with a PhD in engineering mechanics from Princeton. So it's not finance, it's math and it's numbers. And he applied that to the market and he's found some pretty amazing discoveries, I guess is the way we'll put it. So Ray, thank you very much for being with us today. I appreciate you being willing to spend some time with us.
Well, thank you very much, Tim. That was a glowing intro. I really appreciate it. We'll see if I can live up to the hype.
Well, okay. Now, Ray, sentiment. How does an engineer, Notre Dame, Princeton, I mean, the engineering firms have to be beating your door down with that background. How do you get into relative sentiment in the financial markets?
That's a good question. It was a long and winding road. So I started in finance in 1999, but I really didn't get into sentiment and relative sentiment until 2014, 2015. So in the interim, I started doing fundamental analysis and quantitative long-short analysis using fundamentals. So the stuff that you talked to Wes Gray about, value, quality,
Right.
factor, smart beta, that was my life prior to 2010. After 2010, it shifted to more macro. And then in the mid 2010s, I was at a family office and they were interested in tactical strategies that participated in the upside to a large degree, but kind of mitigated the downside risk.
Right.
I didn't participate as much on the downside. And so that's when I started looking at tactical strategies and sentiment came up. And relative sentiment came up. I stumbled upon it one day. I had a pamphlet from Lehman Brothers from 2006.
Oh, God. Okay.
I saved it. I saved it from my smart beta days. And in that pamphlet, and I want to give credit to the people that put it together, Indigo Fraser Jenkins and Ian Scott at Lehman Brothers back in the day. They had this measure that looked at how institutions were positioned in the futures and options market relative to retail traders, looking at the S&P 500.
Mm-hmm.
And so I looked at that indicator and it was okay. It wasn't, earth-shattering, but I really loved the concept of looking at how institutions are positioned relative to retail traders, because just intuitively it felt that if institutions have better outcomes, that's just sort of intuitive. Right. Retail traders. So if you can measure what institutions are doing relative to retail traders, you might be able to get a handle on what markets are doing. So I went down that path, added some different information to the indicator from long duration bonds, the yield curve, and all of a sudden it started to look pretty good.
Okay.
But I didn't think, too much of it at the time until I had a whole bunch of other indicators, value, momentum, etc. And then in September of 2015, all of my indicators were bearish. The market had sold off, 10, 15%. Mm-hmm. All of them were bearish except for relative sentiment, and the market rallied 10% in a straight line. Fast forward 6 months, all of the indicators were bearish again, February 2016, except for relative sentiment. It was bullish. The market rallied and never looked back. And I thought, wow, is that a coincidence? And I went back and checked, and it turns out that when institutions are buying the dip, when momentum is negative, equities tend to have their best performance over the next several weeks on an annualized basis. So that was what got me into relative sentiment, and I've kind of been studying it ever since.
Okay. Now, this sets up the historic thing that we've all known, and retail-based investors hate to be told this, but it's a truth. The institutional money is the smart money. And unfortunately, the retail money does kind of tend to be the dumb money. Does your work support that?
It does support that. Now,
See, I can use words like dumb. I don't have a problem.
try not to use those words, but there's a great quote by Jake Bernstein, who puts out the Daily Sentiment Index. And he said, I'm paraphrasing, but the gist is that the small trader has to win sometimes. If they weren't ever winning at all in markets, they wouldn't participate. And then there wouldn't be any small trader to exploit for the institutions. So, we saw with the meme stocks, we had retail traders winning with those. Yeah. They win, every now and then. They don't bat zero. But over the long term, institutions tend to have better outcomes. And they tend to be right when it is most meaningful, when the market has the really big moves. So yes, unfortunately, retail, unless you have a systematic edge and you're kind of doing this in a very serious way, the longer you participate, the more likely you're going to give a lot of your money back to the market. Okay. If you're trading.
Trading, right. Now, how do you measure this? How do you capture this kind of quantitatively to get emotion and opinion out of it? We want to stick hardcore to numbers. So how do we do that?
Okay. So it's, I'll try to keep this sort of at a low level. I have a tendency to get in the weeds as an engineer, but I look at several different ways. One is how investors are positioned. And I also use some survey data from a company called Centix that polls individuals and institutions separately about how they feel about the market. But let's get back to the how they're actually positioned. So every Friday, the CFTC puts out a report called the Commitments of Traders Report.
Sure.
And it's a snapshot of how multiple different investor classes are positioned in pretty much every futures contract on Earth. And what I do is I look at how the institutions are positioned relative to how they're typically positioned. Mm-hmm. I look at how retail is positioned relative to how they're typically positioned. How are they deviating from their averages? Mm-hmm. And then I compare those two measures to each other to get a final measure of how institutions are leaning relative to retail traders. It's a little bit more in depth than that, but that's sort of the gist.
Sure, that's the gist of it. Okay, now the interesting part to me, how do you take this sentiment data? And I've caught a video where you talked about this, but I think it's important for our readers because we do a lot of factor-based value stuff, and I'm probably the world's only factor-based bank stock investor. I'm pretty sure I'm the guy. But how do we take relative sentiment and use it with some of the value or momentum? How do we use it with factor investing?
Sure. Okay. So it turns out that when you look at relative sentiment and trend following together, they tend to be very complementary. And if you think about it, trend following is a strategy that buys high. As the market goes up, it buys. As the market goes down, it sells. If the market goes below a moving average, trend following gets out or reduces its position. When it goes above a moving average or momentum is positive, it gets longer. So it buys high and sells low. In contrast, institutions who have a lot of money that they have to manage, they don't like to buy high and sell low. They like to buy low and sell high. So what we see is that at market peaks, when trend following is at 100% equity allocation, relative sentiment tends to be at around a 50% equity allocation. So the institutions have kind of sold off as the market has risen. Now, as the market starts to fall, trend following eventually gets out of the market. Relative sentiment kind of hangs around 40, 50% equity allocation. But when the market approaches and gets to its trough, we see that relative sentiment tends to jump up in its equity allocation. So trend following is out of the market when the market's bottoming. Relative sentiment is kind of pushing its chips in, and it has a higher allocation to the market at the trough and as it's moving past the trough. Trend following tends to stay out of the market too long, waiting for the market to go back above a moving average. Meanwhile, relative sentiment captures that. And then once the market does go above its moving average and trend following is back in and the market's no longer in a drawdown, trend following is the strategy that you want because it's 100% invested in equities, whereas relative sentiment doesn't usually get up to 100%. It gets up to 80, 90 occasionally, but rarely gets to 100. So outside of drawdown periods, trend following is great. during trend drawdown periods, trend following, kind of lags a bit, and relative sentiment kind of shines in those times. So they're very complementary in that respect. Now, with respect to value and momentum and trend following are quite similar.
They're very similar, yes.
So I don't want to necessarily make a distinction, but what we do find is that during drawdown periods, relative sentiment tends to provide more information than value or momentum. So what we find is that when momentum is negative, and therefore a momentum investor might think, well, equities are going to continue to fall. Mm-hmm. If momentum is negative, but relative sentiment is bullish, if institutions are buying that dip, we tend to see the market rise. So knowing what relative sentiment is doing in those cases gives you more information than knowing what momentum is telling you. Same thing with value. When value is cheap, but institutions are not buying, it's like catching a falling knife. You don't want to step in there. But if value is cheap and institutions are like, yeah, it's cheap, we're buying, that's when you want to step in. So knowing what relative sentiment is doing tends to give a little bit more information than value or momentum when both of those, when one's cheap and momentum is negative. So that's kind of how they play together. But definitely momentum and trend follow, or excuse me, relative sentiment are very complementary.
So yeah, it sounds like relative sentiment can actually help you kind of pick those turning points in, or confirm potential turning points. It's how many times have I seen guys say, because I've been doing this a long time, well, the market's really overbought, we're going to go short here. And you hear from them 3 months later, it's like, dude, can I borrow $50 to make my rent? Because they're out. And it's been the same thing on the downside. Downside, especially if you're a value guy, you're a little better at catching the downside with that. But you still, the old joke was for years, okay, Tim recommended a stock. Let's wait 6 weeks and buy some.
Yes. That's actually a good point. Like, I don't want to give the impression that institutions are infallible, right? So they don't always catch the bottom. Sometimes they get it a week before, 2 weeks before, 2 weeks after, but they tend to get it a lot closer to the bottom than retail.
They're in the neighborhood.
They're in the neighborhood. And the same thing, it's actually, they're less good when the market's going up and picking a top, because tops tend to be these long drawn out processes, and institutions just gradually sell into them. Whereas bottoms can be V bottoms, where the market just, shoots up after it bottoms, and retail kind of gets in, or excuse me, institutions tend to buy that. But like recently, just in recent history, last October, the narrative was so negative, and everyone was expecting a recession. Everyone was expecting a hard landing. Equities were going a lot lower, and retail really bought into that narrative. And I personally thought, yeah, that's totally plausible. But I'm sitting here watching institutions buy the market. It didn't look good, and it was definitely uncomfortable watching, these indicators, institutions buying the market, because my strategy had to get really long the market when it looked like things were going a lot lower. So a lot of sleepless nights, but it turned out that, okay, the market did turn. And then in May and June and July of this year, as the market was rising, it was very uncomfortable to lower my equity allocation, because institutions were selling into that. So we're seeing a little bit of a pullback here, but whether that continues, to be determined.
Okay. Now, you mentioned commitment to traders. Are there any other tools that are in your relative sentiment toolbox that are worth talking about?
Primarily commitments of traders, also Centix, which is, I mentioned earlier, a company out of Germany. They give all kinds of sentiment information parsed by whether you're an individual or an institution. Sure. So you can take that and you can compare it to each other and then make some decisions. I'm always on the lookout for other data. I haven't really found anything that jumps out at me that I have to use. I do use the daily sentiment index as well. Technically, it's only a small trader sentiment index. It doesn't include institutions. But what I find there is that retail sentiment in commodities tends to be very predictive of equities, and it functions in a not necessarily straightforward way. It makes sense, but it's not linear in a sense. So what we find is that if retail is very bullish on commodities, it tends to mean that commodities have risen. And if commodities rise, that tends to lead to inflationary pressures. So if retail sentiment is too hot in commodities, that's bad for equities. If retail sentiment is too cold in commodities, that tends to mean commodities have fallen, and therefore maybe we have slowing growth, deflation, or recession. So if sentiment is too low, that's also bad. But in this range in the middle, this Goldilocks zone, if retail sentiment in commodities is in that zone, equities do well. So too high is bad, too low is bad. In the middle, just right, that's good for equities. So I also include that. It's not technically a relative sentiment indicator, but it tends to be fairly effective. And interestingly, now it is saying, so all of the sentiment is outside of the Goldilocks zone. Sentiment in oil and other commodities, similar commodities, is very high, but also sentiment in lumber, which is also predictive of equities, is very low. So you kind of have inflationary and deflationary signals flashing at the same time, which I kind of find interesting. Other relative sentiment indicators are still quite bullish the market right now, but and they've actually picked up this past week. But that one that I just mentioned, the retail sentiment is not bullish for equities at the moment.
Okay. Now, can we use this on any other markets outside the S&P 500 or?
Yes. So it works basically for all asset classes, equities, bonds, currencies, commodities. It works for the yield curve. It works for credit spreads. It works for smart beta. But the way that you have to kind of look at it, or the way that seems to work when you look at those different asset classes, is to consider a framework similar to the macro framework, where people look at growth increasing or decreasing and inflation increasing or decreasing. Okay, so the analogous framework would be, how are institutions positioned relative to retail traders in growth-related assets? That would be equities and commodities. And how are they positioned relative to retail traders in inflation-related assets? Those would be currencies and short-term fixed income. If it, what we find is that if institutions are relatively bullish in growth and relatively bullish on financial conditions easing, so they're positioned in such a way in currencies and short-term fixed income that they're positioned for easier financial conditions, risk assets tend to do well. And it's really broad, it's really general. It applies to all those assets I listed, and so we can kind of get a slate of different equities, regions, countries, sectors, different bonds, corporate, government, currencies, etc., and sort of what the tactical positioning is for each of those. So yes, it does appear to work for other asset classes.
Okay, so then can we take this information and use it for a tactical asset allocation model?
We can, and I've been using that recently. So this is something that I've kind of developed in the last, say, 6 to 9 months.
Okay.
And started incorporating it into the relative sentiment strategy. So whereas initially the strategy only held U.S. broad market, developed market equities, an aggregate bond index, TIPS, and gold, now it's currently has some copper, it has some corn, it has some soybeans, it has high yield bonds, it has various different countries and sectors and stuff. So depending on which sectors and countries look the most bullish and which commodities, etc., those can kind of be thrown into the mix. So yes, we can use it for tactical asset allocation.
Outstanding. Now, I know relativesentiment.com is your website. I know I subscribe to your weekly email, and it's one of there's 3 things I open first thing Monday morning, and you're on the list, just to kind of get a snapshot of what's going on. Because true confessions, I'm a really good fundamental investor. I am the world's worst trader. I mean, I've looked for worse. They don't exist. I'm terrible. So anything that helps me add an element of being more aware of the fluctuations of the market is useful, and yours is incredibly useful. So, but is that tactical stuff on your website as well?
Not yet. So we are working on sort of a research product, because we think it could be of interest to people to see, how different asset classes lined up, and when you drill down into the assets in those asset classes. So it's a lot of work kind of putting that all together, but we're hoping to put that out before the end of this year.
Okay. Now, in all of this research, the hot word today, Ray, is artificial intelligence. Are you doing all this, still the old-fashioned way by hand, or are we using anything like machine learning or artificial intelligence to improve our results? Or
we are using machine learning. is part of the process. So I use machine learning with the Centix data. It's a survey data, and the data that I look at, they ask institutions, how do you feel about the economy 6 months forward? And they ask individuals the same question, how do you feel about the economy 6 months forward? They do that for various regions, US, Japan, Europe, Asia ex-Japan, Germany, Latin America, et cetera. So I incorporate that data and I look at, and I run it through an ensemble of different machine learning algorithms. And essentially, kind of do some run some data snooping algorithms, find the ones that are statistically significant and average the allocations across those. And then I walk forward and do it again. And that seems to have been, fairly effective in generally getting the direction of the markets correct the last several years.
Okay.
So we do use machine learning in that, but we haven't used sort of artificial intelligence or natural language processing or anything of that sort, large language models. No, but maybe someday.
Okay. Now, next question, because this has already occurred to me, and I'm sure it's going to occur to a lot of other folks watching this. Can relative sentiment can it anticipate or be predictive of, say, macro market and economic events? Do you see it filling that role at all?
I think it can, in the sense that you can view relative sentiment as an implied fundamental indicator or an anticipator of market narratives, in the sense that institutions have a lot of human resources and economic resources to throw at the problem of what is the state of corporate and economic fundamentals. So they set loose, all these smart MBAs, CFAs, PhDs, they just cutting edge tools and data and say, okay, what's happening? And so they deploy all these resources, they come to a conclusion, and then they take positions in the market reflecting the conclusions that they came to. So in that sense, how they're positioned is an indication of how they think the fundamentals will play out. And so to give you an example, last fall, so Q4, October, November, again, the narrative was very negative.
Right.
All the sell side banks were like, don't buy equities, it's a bear market rally, it's going to roll back over. But what were institutions doing? They were positioning for a soft landing. They were long growth assets. They were short the dollar. They were short the yen. They were long the euro dollar. They were just basically positioned for financial conditions easing and for growth to increase. And then fast forward, 7, 8, 9 months, we get the New York Times, the Wall Street Journal, the Financial Times, all in one weekend talking about the soft landing that's arrived. Yeah. So in a sense, institutions were foreshadowing that back in October, November, and then it arrived. Now, of course, nothing's static, and it might disappear again because we might have a recession, we might have a hard landing. But over those, sort of weekly and monthly tactical periods, how they're positioned could anticipate the information that you're getting from the financial media. And I think one of the reasons why relative sentiment works is because I think institutions have a lot of influence over the narrative, right? So
sure.
Goldman Sachs goes on CNBC, Morgan Stanley goes on Bloomberg, and they tell you what to think about the market. They tell you what to buy, what not to buy. It's always interesting to me how the market will be selling off. It seems like the world's ending. And then you go to sleep and you wake up the next day and Goldman Sachs has written a research report saying it's not as bad as we thought, and the market gapped up 2%. And if you sold the day before, then now you're chasing. So they have a lot of control over the market narrative, and I think that their positioning can help anticipate that.
Okay. Now, I can obviously do this for hours, and it sounds like you can too, but we shouldn't do that because we have other stuff we're supposed to do today. But I do want to touch on something that's near and dear to my heart. And you talk about it every week, and you've done some really good research on it. It's some of the best I've seen. And that is the average individual allocation to equities. This has been referred to as the perfect market measure. I have a tendency, the word perfect scares me, but it's pretty damn accurate, isn't it?
It's reasonably accurate. At various points in time, it's been exceptionally accurate. So if you go back to 2000, at the peak of the dot-com bubble, this indicator was forecasting, I think, minus 1% annualized from 2000 to 2010, and we got something like minus 0.6% annualized in that time period. You fast forward to the bottom in 2009 in March, in that time period, it was forecasting 15.8% annualized, and we actually got 16% annualized. So I mean, it has a very tight range around what the actual returns tend to be. Except if you look in 2021, when the market kind of, we had all that liquidity in the market from the Fed and the everything bubble, it did kind of diverge by a little bit more than it tends to diverge from the forecast, but it's coming back down, and it doesn't really paint a rosy picture for the next decade.
No, it doesn't.
Right now, so at the top in 21, it was forecasting minus 1% annualized, or it was definitely negative. It was like maybe minus 0.5% annualized from 2021 to 2031. Now it's forecasting roughly about 2.3% annualized from here over the next 10 years. And the 10-year bond is, yielding 4.16. So you have negative risk premium at the moment.
Yeah, it's not going to feed the bulldog, as my dad used to say. So
no.
Let's take a second and back up. Let's explain what that is, just so everybody kind of knows.
First, let me give credit where credit is due. There's a blogger that goes by the pseudonym Jesse Livermore on Twitter, and he put out a brilliant blog post in 2015, I believe it was, called The Single Greatest Predictor of Equity Returns. And it was this indicator. And what it is you take the total market value of equities and you divide it by the total market value of equities plus bonds plus cash. So basically, what percentage are equities of the total market portfolio if the total market portfolio is equities, bonds, and cash? When that number gets too high, equities have poor forward prospects. When it gets too low, they have great forward prospects. And I encourage anyone who's interested in it to read that blog post because it's very elegant, the work that he did. And he compares this approach to the typical earnings and valuation approach. And, he kind of points out the analogous components of this measure, the AIAE, to a price to earnings multiple. And one thing that's really interesting, so, people tend to say the market follows earnings. But in the 1980s, earnings fell from the beginning of the period to the end of the period, yet the market had a huge rally in the 80s. And the reason is because equities were such a low percentage of the market portfolio at that time coming into the 80s,
right?
Because of the bear market of the 70s that ended in 82. If equities didn't rise, they would have become a minuscule part of the market portfolio. And so in order for them to basically keep pace as a percentage of the market portfolio, they had to rise. So this kind of makes one question: does the market really follow earnings, or does it follow sort of a desired allocation profile to equities and bonds? And if there's a lot of bond issuance out there, and now your portfolio is overwhelmed with bonds, well, in order for that to balance out, equities have to rise to become a bigger part of the portfolio, regardless of what happens fundamentally with equities. So it's a very interesting indicator from that standpoint.
Okay. Now, just because I don't want to take your whole day, two final questions here.
Okay.
First off, if you don't mind, what's the data telling us today, Monday, August 14th, 2023?
Okay. So it's actually a little bit of a mixed bag. If you look at an average of several different relative sentiment indicators, right now it's at 74%, which is a solidly bullish number. So it suggests that this sell-off that we're having, I'm not saying it's over, but the dip will probably be bought at some point. But what's really interesting about it is that if you look at just what institutions and retail are doing in equities, it's bearish for equities. Institutions are selling, retail is buying. But if you look at other cross-asset information, which actually is important to kind of throw into the mix, what are they doing in currencies? What are they doing in commodities? That's bullish for equities. So overall, it still has a bullish backdrop, but there are some cross currents underneath that bear watching. Another thing to look at is the dollar. It's had bearish relative sentiment since October of last year. It's fallen, but recently the relative sentiment hasn't gone bullish, but it keeps flirting with going bullish. Like it goes up, stuff's coming back. And it's really, kind of annoying, to be honest with you, because I keep saying, it's going to turn bullish. No, it's not. It's really, teasing. But if it does turn bullish, that could change the tone of the market in terms of how risk assets perform. Another thing that is interesting is that gold, institutions are buying gold. They've been buying gold the last several weeks, but retail has been buying it more. So on a relative basis, institutions are actually bearish on gold, and gold's really not doing much, and they're also bearish on silver. So that's sort of the lay of the land. They're bullish equities, they are bearish the dollar, and gold kind of neutral, bearish on silver though.
Okay. All right. Now, final question. If you could teach investors or there's one thing that individual investors need to learn, what would that be?
Well, I've learned this the hard way. It's don't get caught up in your emotions. Your emotions, the market behaves, it seems that the market is sentient in a way, and that it behaves in a way to create maximum FOMO or maximum panic and causes you to do the wrong thing at the wrong time. So I would say find a set of rules or an investment manager that follows and you trust them and live your life, because this is a grind. This is not fun to be doing if you're, an individual investor and, you're spending all your time looking at screens. There's a whole life to live out there. So
Yes.
Don't be emotional, use rules, and go live your life. That's what I would say. Because I spent a lot of time on screens and I'm kind of thinking, is it worth it?
Yeah. You're not telling me I can't really get rich by next Tuesday, are you?
No, you can. I didn't mean to give that impression that you can. Of course you can. But no, it's tough. It's tough. So FOMO and panic, they cause you to do the wrong things. Emotion is your enemy. Try not to get caught up in it. Use some type of systematic rules-based strategy, whatever it is, and then go live your life.
That's perfect, because it's way too many people, I think, spend too much time in front of the screen trying to get rich by next Tuesday.
Yeah.
When a less emotional, more quantitatively driven, longer term thinking process is probably going to make you rich long before you trade your way to being rich, no matter how optimistic it may appear at the time.
Just hit singles, walks and singles. Don't go for the home runs, and you'll be a lot better off.
Say, now all of my audience understood that, because I bore them to death with baseball stuff all the time. So
right. Wonderful.
Right. Ray, thank you so much for being with us. I appreciate it. Just thanks for being on. I know you're a busy guy, and giving us half an hour today was very generous. So thank you.
Well, thank you, Tim. It was a pleasure. I really enjoyed it.